Sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Jack Otter. Coming up, a roadblock for the EV industry as it faces a slowdown. Ford CEO Jim Farley on what it'll take to get more Americans to go all electric. And later, markets have hit all-time highs in 2024, but what goes up could come right back down if the economy falters. We'll take a look at where cautious investors should put their money. But we begin with our expert panel on three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Al Root, Elizabeth O'Brien, and Andrew Berry. So, Al, we had another strong jobs number on Friday. I feel like I have said that once a month for about 2 years.
Yeah.
Investors didn't quite know what to make of it, but the market did end up higher on the week.
Yeah, and so we had a good jobs number, 272,000, about 90,000 more than economists expected. And initially, it was bad news. Good news was bad news. The market sold off, but then it sort of settled down. We had the JOLTS number earlier in the week, the job opening loss and transition survey. That was a little weaker. So we had 1 week, one good. And so this idea that the economy is still cooling, basically the market said, you know what, one strong figure, it's okay. We'll just keep buying stocks, probably because of split mania and things like that.
Split mania? Tell me more.
Yeah, I mean, NASDAQ all-time high on Wednesday, finished up more than 2% for the week. By the way, what drives that? NVIDIA up 10% for the week. NVIDIA is up 27% since earnings on May 22nd. That's when they also announced that they'd split 10 for 1. By the way, your NVIDIA shares are now worth $120, but you have 10 of them. The split goes into effect on Monday. So it's just been wild. And now we have this market where it is more, we said concentration was an issue.
Sure. Last
year at this time, top three stocks, Microsoft, Apple, NVIDIA, 16% of the market. Now they're 19% of the market. NVIDIA alone is 21% of the year-to-date gains in the S&P.
That's a little scary. If bull markets die on euphoria, that sounds euphoric. And in case that's not enough, Roaring Kitty and GameStop are back, the original OG meme stock.
Yeah, I for the table, took one for the team. I watched part of Roaring Kitty's YouTube stream. It is an experience. Listen, he is a trader. It does mean something. There were 444,000 people watching the stream when I tuned in, and our colleague Connor Smith was watching. He says GameStop is his only position. GameStop, it was down 40% today. Oh, but by the way, it's still up 20% for the week. It's up 180% off its 52-week low. Oh, that was April. But it's down 55% from its 52-week high. Oh, that was a couple weeks ago.
Don't try this at home.
Don't try this at home, but we should all watch it to see what it means.
All righty. Next week, the Fed. We'll see what happens. But I want to go to Elizabeth. Next week is also Apple. That stock had been lagging until May. It's perked up recently because I think investors are hoping for big news next week.
Yes, that's right. The Apple's annual developers conference kicks off next week, and that is the very same conference where the company highlighted the Macintosh computer 40 years ago. Can you believe it?
Unfortunately, I remember that.
So do I. Yep. Investors will be looking to the tech giant to see for clues on its AI strategy, and questions include whether it will partner with a third party like OpenAI or Google to develop AI, or whether it'll go it alone. And Apple is also expected to give Siri a makeover, an AI makeover, so it can do more complicated things.
Siri definitely needs a makeover. But how does Apple actually make money off of this?
It's not going to monetize AI directly. Now, this is in contrast to search, where Google pays Apple for, $20 billion a year, so that Google will be the default search tool in iPhones. That's not going to happen with AI. So it's going to be on Apple to create some killer apps that are just going to sell more phones, and they'll make more money that way.
Got it. All right, Andrew, first of all, nice tie. Second of all, Bill Ackman, one of the most entertaining characters on Wall Street. Barron's wrote about him a few years ago. We called it the greatest trade of all time. He took $27 million of credit default swaps and turned it into $2.6 billion in 10 days. You've done some exclusive reporting. What's up with him now?
Well, he has a big ego and big ambitions. He's looking to raise $25 billion from retail and institutional investors by the end of July for a new mutual fund. You could be hearing about it from your broker soon. He's had his ups and downs performance-wise. The last 5 years have been great. He's been crushing the S&P 500. And he's also got one of the biggest social media media presence is of any investor. He's got 1 million followers on X. He's been a big supporter of Israel, a critic of DEI. He's been going after Joe Biden recently for being senile. He called him an embarrassment this past week. He may support Donald Trump. So he's basically got a big presence. And the new closed-end fund is going to basically be focused on what he calls high-quality North American growth companies. One negative is going to be a relatively high fee of 2 percentage points annually, even though he's going to waive that for the first year. That's more than double what the typical actively managed fund charges.
So either way, Bill makes money. Real quick, should investors buy this ETF?
You know, if you're like Ackman, the alternative, which I think is a little bit more attractive, is Pershing Square Holdings, which is a European-listed closed-end fund that he manages, and it trades at a 25% discount to its portfolio value. U.S. investors can buy it, even though it's a little bit more difficult, and it owns stocks like Chipotle, Alphabet, and Hilton, which may be in the new fund.
Alrighty, either way, it'll continue to be entertaining.
Yeah.
Thank you, Andrew. Americans are charged up about hybrid vehicles. Ford CEO Jim Farley on what's working and what he's fixing at the company. That's next. An iconic train station in Detroit is getting a second life as Ford expands beyond car making. Michigan's Central Station just reopened Thursday for the first time in more than 3 decades after Ford bought the property back in 2018. The automaker has spent the last several years renovating the space to house not only the company's autonomous vehicle teams, but also an event space with shops and restaurants that's open to the public. Here with us now is Ford CEO Jim Farley. Jim, great to see you again. Thanks for joining us.
Thank you, Jack. Look forward to talking about this great place.
Well, super. So, Al and I have a whole bunch of questions for you, but I do want to start right there in Detroit. You know, I just hosted a financial conference in Vegas, and there was all kinds of buzz about the revival of Detroit, a lot of excitement about what's going on there. Tell us what you're doing at Central Station.
Well, this is such an iconic building that really represented the decay of Detroit and many Midwestern cities, and here we are with a brand new building, bringing back so many wonderful things. You know, the city of Detroit is growing for the first time in decades, and the car company, Ford, is growing. We didn't go bankrupt many years ago, and now we, despite the EV headwinds, you know, the city is thriving, Ford is starting to thrive, and I think Michigan Central Station's not only a beautiful place for the city, but it's a symbol for, you know, what can be done in America.
And Jim, you know, part of the renaissance of the auto industry, like Michigan Central, is EVs. Now, you referenced the slowdown, even though Ford has had an excellent start to the year. Why do you think the overall sales level is dipping? Is it an affordability issue, a charging issue? Is it just how Americans like to drive, or is it something else?
Yeah, we are number 2 in EVs for the last couple of years, Al, so we think we understand the market. We're entering new customers, the mainstream customers, and they're not willing to pay a premium for EVs. You know, they don't know how to handicap the charging, the resale value, insurance has gone up, and they don't know how to handicap that. They could do the math on a hybrid. You know, we're also number 3 in hybrids, and we're the only company that kind of offers all 3 on an America's best-selling vehicle, the F-150. We even have an electric and a hybrid, and we just hear hybrids are attractive because people can do the math. They can figure out how much money they can save on their gas. And electric, the mainstream customers, not the early adopters, you know, that we're seeing now, they don't know how to handicap the actual experience.
In Q1, I believe, because of those heavy R&D spending, you're about $1.3 billion in losses. You sold about 10,000 vehicles. But as someone who has driven an EV, that one-pedal drive is kind of fun. It's responsive. Yeah. How long is this going to take to catch on? What's your path to profitability here?
It's the most important question in the car business because the emissions requirements require us to sell a very high percentage of EVs. And we decided to break out our business because we want to hold our team accountable to be a profitable, sustainable business. Look, it's going to take the same thing that's required for 120 years. We got to cut our costs because customers aren't willing to pay a premium. And that's going to require breakthrough engineering, breakthrough manufacturing, and breakthrough supply chain negotiation with our suppliers.
You know, we hear a lot about cheap Chinese vehicles. They're entering Europe. They haven't arrived here yet. And now we have 100% tariffs. While all that investment is going on, Are the tariffs necessary for Ford to compete? Are they temporary? What's your take on sort of the political level that's going on in EVs now?
Well, look, we think our political leaders have a big job to do. You know, in China, it's the biggest car business in the world. They have 53 million units of capacity, and they have a local market of about 29 million. That capacity difference that's unused is bigger than the entire U.S. market. And so our policy leaders have to get serious about policies around privacy, around national security, because the vehicles are autonomous. They can do all sorts of things and be controlled remotely. And we have to be serious about, you know, playing an even playing field.
There seems to be more interest in hybrids in the last couple of years. How do you sketch out that business?
Boy, we cannot keep up with the capacity for hybrids. You know, we've invested more than 20 years ago. Many of our truck competitors don't even have hybrids on their trucks. 25% of F-150, which is the best-selling vehicle in the U.S. I mentioned, is now hybrid. And you can use the hybrid batteries for exportable power. So if you lose, you know, your grid, you lose electricity at your house, or you want to run a job site, with an F-150 hybrid, you can run your house for 7 days. It's good for, you know, tailgates too. But you know, we're seeing our hybrid sales in the first quarter go up about 40%. And we've had to add a lot of extra supplier capacity to catch up to the demand.
Ford Pro, your fleet sales,
yes,
16.7% margins. That's pretty unusual in your business. I think it was $3 billion in revenue in the first quarter. Can you keep it at that pace?
We think Ford Pro is the profitable engine at Ford. I mean, this is what we do. We're the global leader in pickups. We're a leader in the U.S. and Europe in vans. I mean, this is what Ford does when we get up in the morning. We do iconic vehicles like Bronco and Mustang, and we do commercial work vehicles. We serve the American worker who builds our economy, the plumber and the electrician. That's the heart of the market, and that's who we serve. It's the most profitable business at Ford, and what's exciting is it's no longer just vehicle sales. Really, the highest growth part of Pro is our software sales. We have over 500,000 subscribers for Ford Pro productivity software, and we have parts sales.
Jim Farley, thanks so much for coming on, and congrats on the Central Station work.
Thank you, guys. Appreciate the time.
Investors are seeing markets hit record highs this year, but what happens if the economy turns south? Strategist David Rosenberg on how cautious investors should position themselves next. Investors are enjoying huge earnings growth and stock market records despite persistently high interest rates and pesky inflation. Could both the bull market and that inflation go away? Rosenberg Research President and founder David Rosenberg joins the panel. David, thanks for joining us.
Pleasure's mine. Thanks for having me on.
Sure thing. So we had another strong jobs number Friday morning. Higher for longer is increasingly becoming the consensus, and stock investors obviously are optimistic, but you've been sounding a cautious note in the economy for a while. What is conventional wisdom getting wrong?
Well, I think that what people are ignoring is the fact that, you know, we had 3% growth in the economy last year, and everybody seems to be feeding off the numbers from 2023. You know, first quarter GDP already got marked down to 1.3. We're tracking something, call it 1 plus for Q2. So we're in sort of a stall speed economy. You could argue not a recession yet, but this is now a 1% plus growth economy. So it's decelerating. And then the next question that has to be asked is, where do we go from here? We've gone from 3% to 1% plus. What's the catalyst for taking us back to reacceleration mode?
You wrote recently, quote, time to give all the inflation chatter a rest. Tell us why it's going away.
Right. Well, look, one part of the inflation decline from the 9% peak was the improvement in global supply chains. But the other part that's starting to kick in is the demand side. And you just have to take a look, number one, at the Fed's Beige Book, which was replete with commentary from businesses that they are seeing a rapid diminishment in their pricing power. And I mean, you could look at the government data, or you could look at the real world and look at what all the retailers were telling us in the latest quarterly reporting season, which is that we're seeing widespread discounting because consumers are pushing back against the previous price increases. In fact, in a lot of cases in the retail sector, prices aren't just stabilizing, they're being rolled back.
Given your views on inflation and the economy, what do you think about the bond market right now?
Well, that's probably my strongest conviction call, is I think that bond yields are going to come down, because I don't think that recession is something that's not going to happen. I know that everybody has thrown caution to the wind and thrown the recession call into the waste paper basket, but remember, they did that back in 1989. They did that back in 1990. They did that back in 2007 when I was at Mother Merrill. And the lags have been longer this time, indeed. But does anybody really believe that the business cycle has been repealed, and that in the most acute credit-driven cycle of all time, that interest rates don't matter? The lags are longer this time. And we're going to have a recession. Inflation is going to surprise to the downside. I'm not going to try and time all this stuff. I just know what the destination is. The destination is recession. Destination is much lower inflation. And the Fed will be cutting interest rates, and that's going to drive yields down the entire curve between now and this time in 2025. So I am resolutely bullish on the Treasury market.
But I think you're still bullish on gold, David. And with falling inflation, I typically think of it as an inflation hedge, but I think you still like it. So how do you reconcile that one?
Well, look, because there's other reasons to like gold, and the fact that the People's Bank of China is continuing to diversify into bullion for geopolitical reasons is a very big reason. On top of that, India continues to see 8% plus growth in their economy, and that's generating tremendous retail demand. So a lot of this is not just about inflation, but it's also about flows of funds. And the central banks, as we know, have very deep pockets.
Appreciate you coming on.
Take care.
Al and Elizabeth have a pair of investment ideas, and Andrew tells us about 3 titans of Wall Street who may step down soon and who could take their place. Stay right there. Andrew, 3 titans of Wall Street are coming somewhere near the end of their reigns. Who's going to fill those big shoes?
Well, 3 companies are Blackstone, BlackRock, and JP Morgan. And 3 CEOs there have outsized reputations. There could be big shoes to fill. Let's start with JP Morgan. Jamie Dimon, 68 years old now, leading banker in the world. And the thinking is he may retire after 2026 when some options that he's going to get will vest. The leading candidate to replace him is Marianne Lake, who is British-born, and she was the well-regarded as the chief financial officer of the bank. Now she heads the consumer business, and I think she's very well-regarded internally.
Next up, Steve Schwarzman. He was the very first guest on this show, and he's, 77?
Yeah, he's 77 right now. He's the founder and controlling shareholder of Blackstone, which is the leading alternative asset manager in the world. His most likely successor to him is the number 2 right now, who's John Gray, who's built their real estate business, well-regarded there. And the final one is Larry Fink, one of the founders and the CEO of BlackRock, which is the leading asset manager in the world ranked by assets. He's built a phenomenal business, even though he's probably best known more recently for all the controversy involving his ESG statements. Well, I mean, the odds-on favorite there is someone named Mark Wiegman, and so he's been there about 20 years, and he came from McKinsey.
That's a lot of market capitalization we just saw on that screen. Let's go to actionable ideas. Al, what do you have for us?
Lockheed, this week, they helped launch Boeing Starliner into space. That's not why we like it. It really is about backlog. We worry about the defense budget, but Lockheed has $160 billion in backlog, more than 2 years of sales. Backlog's up from about $110 billion pre-pandemic. So it has a lot of business that it can fulfill no matter what the defense budget does.
And as long as guys like Vladimir Putin are still in power, I think defense contracting is going to be a lucrative business. Elizabeth, what do you have for us?
Yeah, well, according to a new survey by Principal Financial Group, there are a bunch of workers who think they are contributing to their 401ks, but they are, in fact, not doing so. So bottom line, the rules are different from company to company. Some plans will auto-enroll you, some plans won't. So even if you think you're saving money in your 401k, check your pay stub to find out.
And now that they don't send you a pay stub anymore, you need a password to go online.
Exactly. You got to go online. It's a whole hassle.
It's worth it. Do that once in a while. See where your money's going. All righty. Al, Elizabeth, and Andrew, thanks so much. To read more, check out this week's edition at barrons.com. Watch Barron's Roundtable and don't listen to Roaring Kitty. That's all for us. We'll see you next week on Barron's Roundtable.